Bull Bear Buzz podcast for decoding markets, fueling minds. Welcome to the deep dive. Today, we're getting into the weeds of the IDFC First Bank earnings call. This is for the quarter and year ending March 31st, 2025.
Right. We've gone through the transcript, looked at what Mr. Vaidyanathan, the MD and CEO, and Mr. Jain, the CFO, had to say.
Exactly. And our mission, as always, is to pull out the really important stuff for you. Save you the time, basically.
Give you the key highlights, the strategy, the outlook, without you needing to sift through the whole thing.
And speaking of highlights, here's something that, well, it really caught my eye. This bank, faced some, let's say, initial skepticism.
Definitely. Labeled hard to solve, even.
Right. But look at their deposits. They've gone from about 38,000 crores to, get this, 2.42 lakh crores.
That's a staggering number, a huge leap.
So we're definitely going to unpack how they pulled that off and what it signals for their future path.
It's a fascinating transformation story, for sure. We need to look at the strategies behind that growth.
Absolutely. So here's the plan for this deep dive. We'll kick off with the key financials, Q4, and the full year. Then we'll dive into their strategy. The recent capital raise is a big one there, and their plans for profitability.
And asset quality, of course. Always crucial. How healthy are those loans?
Yep, asset quality, managing costs, and their view on key bits of the business like microfinance, which has had challenges, in credit cards. Ready to jump in?
Let's do it. Lots to cover.
Okay, first up, let's hit those financial performance highlights for the full year, FY25. Their balance sheet reached 3.4 lakh crores. That's up 16% year on year.
Solid growth. But the deposit story is even stronger, wouldn't you say?
Totally agree. Customer deposits jumped 25% year on year, hit 2.42 lakh crores.
And importantly, the retail piece of that grew even faster, 26%. That shows real traction with individual savers.
And their CASA ratio current account, savings account that stayed pretty stable, around 47%.
Which is good. That's your lower cost funding base.
Right. And the actual CASA deposit amount also up 25% year on year. Average CASA for Q4 alone was up 30%. So the base itself is growing strongly.
That stability and growth in CASA is really healthy. It's sticky money. We also saw term deposits grow 26%, with retail TDs slightly faster at 28%. So broad-based deposit growth.
They've also expanded physically, crossed the 1,000 branch mark, ended March with 1,002.
Wow, 1,000 branches. That's a significant milestone. They added 31 just in Q4.
Shows commitment to that physical presence.
And on the other side of the balance sheet, they've been cleaning up, repaid 7,000 crores of that expensive legacy debt in FY25.
Yeah, that's a big chunk gone. What's left?
Only about 4,800 crores remaining, and most of that, 4,500 crores, matures next year. So that headwind from high-cost borrowings is really diminishing. Should help their interest costs.
Definitely. Another key ratio, credit to deposit, that's come down, was 98.4% last March. Now it's 93.9%.
And the incremental ratio, just looking at the last year's growth, was even better at 76.1%.
Means
they're comfortably funding their new loans primarily through deposit growth, not just borrowing more. Better liquidity management.
Got it. And their cost of funds, cost of deposits, stable around 6.5% and 6.38% in Q4.
Yeah, holding steady, which is good in this environment.
Okay, let's shift to asset growth. Funded assets up 20.4% year on year, reaching 2.42 lakh crores. That's 4.7% growth just in the last quarter.
And where's that growth coming from? It seems pretty diversified. Mortgages up 19%.
Vehicle loans, 26%.
Business banking that's mostly secured, working capital up a strong 32%. Even wholesale saw 29% growth.
So not just relying on one engine. What about the smaller segments?
Gold loans and credit cards growing fast too, though, from a smaller base, obviously.
Let's talk credit cards for a sec. Over 3.5 million cards issued now.
And the book size is 7,500 crores. Gross spends on those cards grew 42% in FY25. That's rapid expansion.
And they made a point about profitability there, didn't they?
They did. Said the credit card business hit operational break-even within just 4 years of launch. That's pretty quick in this market. Suggests an efficient model.
Okay, but not everything was rosy. Microfinance. That saw degrowth, right?
Yeah, down 28.3%. They put that down to broader sector issues, which we know have been happening. We'll need to dig into that more.
Agreed. On the flip side, the old infrastructure book is tiny now, less than 1% of assets. So lower risk there.
Right. Okay, so that's the growth picture. Now, the crucial part, asset quality. How are those loans actually performing?
Okay, asset quality, headline gross NPA, so it's 1.87% as of March end.
But they break that down,
Break
right?
it down.
Excluding microfinance?
Yes, ex-MFI, it's better at 1.63%. And importantly, that actually dropped 19 basis points just from the previous quarter.
That's a good sign for the core book. And net NPA?
Very low, 0.53%.
And the provision coverage ratio, PCR, how much are they setting aside?
Strong, 72.3%, excluding technical write-offs, and that's up quite a bit, 347 basis points year on year. So a decent cushion.
Okay, what about the big retail, rural, and MSME chunk?
GNPA there is 1.70%, net NPA 0.62%. But again, if you strip out microfinance from that segment, the GNPA improved quarter on quarter, went from 1.46% down to 1.40%.
So seeing improvement in the core retail and SME book too, that's positive. Any major restructuring?
Doesn't look like it. Standard restructured book is tiny, just 0.18% of assets. Suggests they're not kicking the can down the road much.
What about early warning signs? SMA 1 and 2?
Ex-MFI, those are pretty stable at 0.87%, just a tiny tick up from 0.82%, so not flashing red there.
But MFI itself?
Yeah, within microfinance, SMA 1 and 2 did increase from 4.56% to 5.0%.
Okay.
But, and this might be important, they stressed it's on a shrinking loan base for MFI. And SMA 0 in microfinance, the earliest stage of overdue, actually fell sharply by 45% quarter on quarter in value terms.
Interesting. Could that mean the stress in MFI is peaking? Maybe. Need to watch that.
Could be. Collection efficiency overall looks solid, though, 99.2% in March, even higher ex-Karnataka.
And slippages. Loans turning bad.
Gross slippage actually came down in Q4 to 2,175 crores. Now, MFI slippage did go up within that, but non-MFI slippage decreased. Net slippage after recoveries was also slightly down versus the previous quarter.
And recoveries themselves?
Recoveries and upgrades held steady at about 655 crores. So overall, yeah, MFI is clearly a pressure point, but the rest of the book seems to be holding up or improving.
Okay, that makes sense. Let's pivot to profitability then, the bottom line.
Profitability. For the full year FY25, net interest income, NII, was up 17% year on year.
Solid NII growth.
And that's the same 17% even if you exclude the MFI drag. Q4 NII growth was a bit slower, 10% year on year.
And NI, net interest margin.
NI on AUM for Q4 was 5.95%. It did dip slightly by 9 basis points from Q3. They attributed that mainly to the MFI dynamics.
Okay. What about non-interest income, fees and such?
Fee and other income grew 15% for the full year. Q4 was up 6%. And retail fees are the vast majority, 92% of total fees. Shows that retail focus.
Makes sense. Now costs, operating expenses, always a key area.
They seem to be getting a handle on that. OPEX growth for the full year moderated to 16.5%, and in Q4 it slowed further to 12.2% year on year.
That Q4 number, 12.2%, that's quite a bit lower than loan growth, right?
Exactly. And they highlighted a trend. The YOY OPEX growth rate has been coming down sequentially for 4 or 5 quarters now, from over 21% down to this 12.2%.
So signs of operating leverage starting to kick in. What's their target?
For next year, FY26, they're aiming for OPEX growth around 12-13%, while expecting loan growth around 20% and deposit growth maybe 22-23%. So definitely targeted that positive operating leverage.
Okay. So core operating profit, how did that look?
For FY25, excluding trading gains, core op profit was up 17%, but if you exclude MFI, it was up 31%.
Wow, that's a big difference. Shows the MFI impact clearly.
Yeah. And for Q4 alone, ex-MFI core op profit was up 20% year on year.
But then came the provisions. Those were up sharply for the year, weren't they?
They were. Provisions hit 5,515 crores for FY25, compared to about 2,400 crores the year before, primarily due to MFI needing higher provisions.
Did they use those contingency provisions they'd set aside earlier?
No. They mentioned they didn't touch the 315 crore contingency MFI provision in Q4. The sequential increase in provisions was mainly fresh MFI provisioning.
So that pushed up the credit cost for the year.
Yes, full year credit cost was 2.46%. But again, ex-MFI and a one-off toll road issue was 1.76%. And Q4 credit costs actually improved sequentially, down to 1.73%.
What are they guiding for credit costs next year?
They expect about a 50 basis point reduction for FY26, targeting around 1.85% to 1.90%.
Okay, so all that feeds into the final profit after tax payday.
Right. FY25 payday came in at 1,525 crores. Q4 payday was lower at 304 crores, hit by the MFI impact and normalizing credit costs.
And the outlook for PATE next year?
They were cautious for Q1 FY26, expecting no year-on-year growth, but they anticipate meaningful growth resuming from Q2 FY26 onwards.
Okay. And capital position. CRs.
Still strong. CRR at 15.48% as of March end. CET1, the core equity, at 13.17%, and the board recommended a small dividend, 25 BPs for FY25 pending approvals.
And then the big news post-quarter and the capital raise.
Yes, the board approved issuing those compulsorily convertible preference shares, CCPS, for 7,500 crores to marquee investors.
That's a significant infusion. What does that do to the capital ratios?
Pro forma, based on March numbers, CRAR would jump to 18.2% and CET1 to around 16%. That provides a very strong buffer.
Any major conditions on conversion?
Main one seems to be the stock price needing to stay above 60 for 45 trading days. Investors get an 8% return in the meantime. Didn't sound like there were other significant riders.
Okay. And liquidity, LCR?
LCR averaged 117% in Q4, up from 114%. Comfortable. They expect a small, maybe 1-2% hit from new LCR rules, but manageable.
So putting it all together, it's a picture of, well, strong core growth, decent cost control emerging, but definitely navigating those MFI headwinds. And now with a much stronger capital base post the raise.
Exactly. Let's move into the strategic discussion from the call. A key point was why raise that much capital now?
Right. And Mr. Vidyanathan addressed that. He talked about the bank's starting point, low profitability, structural issues they inherited. The goal was to build a really solid franchise first, one that would attract long-term investors.
And the argument is that the underlying economics are strong now.
That's what he implied. Said operating profit is now reaching around 2.3% of the book. So the incremental business is profitable. He even drew a parallel to ICICI Bank's early days, needing capital raises for long-term growth.
And the end game in self-sufficiency.
Yes, hitting that 15-16% return on equity target. That's the goal for becoming self-sustaining. Right now, core ROE ex MFI, they estimate is around 7%. The near-term milestone is 1% ROA by Q4 of FY26.
Okay, let's talk more about those MFI challenges. It clearly impacted FY25.
Definitely. Industry-wide problems. They expect recovery from FY26 onwards. And that point about SMA 0, 1, and 2 declining in absolute value terms, that was positioned as a sign maybe the worst is over.
What was the full year MFI credit cost?
Around 10.5%, pretty high. But they expect the MFI book size to shrink further, down to maybe 3.5% of total loans next year, so less impact going forward.
Makes sense. Another big strategic focus, cost management. You mentioned operating leverage earlier.
Huge focus, targeting that 13% OPEX growth against 22% business growth. They talked about specific cost cuts, but also bigger projects like call center automation driving efficiency.
What's the long-term cost target?
Cost-to-income ratio down to 65% by FY27. They see big leverage potential, particularly from credit cards projecting CI there, dropping from 100% now to maybe 75% in 2 years, and also from scaling the retail liability side.
Interesting. And on the liability side, the deposit strategy, are they planning changes?
Yes. They signaled plans to reduce both FD and savings account rates over time, move closer to the rates offered by the bigger banks.
Earning what?
Higher value term deposits initially. They seem confident they can hold on to their SASA ratio despite rate cuts because of their service and customer experience focus.
What was the blended SA rate in Q4?
Around 5.9%. They also want to grow the current account piece, which is about 7-8% of deposits now. CA grew around 21-22% last year.
Okay. And overall growth targets?
Yeah.
Still aiming high.
Seems like steady growth is the plan. Around 20% for the loan book feels comfortable for them. CD ratio expected to settle in the high 80s.
And funding that growth mainly via deposits.
Absolutely. Less reliance on borrowings. Borrowings are currently 11% of liabilities. They want that much lower, closer to peers like ICICI at maybe 6.5%.
Got it. Let's circle back to credit cards. That operational break-even seemed significant.
Yeah, achieving that in 4 years, they put down to their digital focus and strong customer pull. They're expecting solid profitability post-credit costs in the next couple of years.
And longer term.
Talked about it spinning cash by FY28 or FY29, so becoming a significant profit contributor. Credit costs on cards are apparently down year on year and expected to fall further. They didn't give the revolve rate, though.
Okay. Just a couple more points. Fixed versus floating rate loans.
About 61% fixed, 39% floating, and of the floating, 30% is linked to repo.
And fee income growth next year.
Expecting around 15%. Their fee to total assets ratio for FY25 was 2.09%. So, summing up the strategy, it's about leveraging the deposit franchise, driving efficiency for operating leverage, navigating the MFI issues while shrinking that book's proportion, and scaling up newer businesses like credit cards, all underpinned by that recent capital raise.
Yeah, that seems like a fair summary. This deep dive into IDFC First Bank's call really paints a picture of a bank, well, working through some legacy and current issues, especially MFI,
Right.
but also showing strong growth in key areas and laying out a clear path towards better profitability. Building that deposit base, managing costs, the capital raise, these are all important pieces.
The focus seems to be on building that sustainable, profitable franchise for the long haul. The comparison to ICICI's journey was interesting in that context. Patience seems key.
Definitely. Though the reliance on getting those cost efficiencies in the ongoing MFI situation do raise questions, don't they, about how quickly they can hit those ambitious ROE targets.
For sure, there are still execution risks. Can they achieve that operating leverage? Will the MFI recovery happen as expected? Potential headwinds always exist. Balancing growth with profitability and risk is always the challenge.
Indeed. It's a story worth watching. How effectively can they navigate this dynamic market while pushing for both growth and those improved returns? It leaves you with something to think about.
It does. And on that note, that brings us to the end of our deep dive on IDFC First Bank's earnings. Just a reminder, everyone, the information we've discussed here is purely for educational purposes. It is absolutely not financial advice.
That's right. We are not SEBI-registered advisors. Investing in stocks always involves risk, and you could potentially lose money.
So please, always consult with a qualified SEBI-registered financial advisor before making any investment decisions based on anything you hear. We aren't liable for any losses resulting from decisions based on this discussion.
And for unbiased market updates, you can check out the Bull Bear Buzz podcast.
Thanks for tuning into this deep dive.
We'll catch you on the next one.